Eric Mwathe with Mwathe.com for the weekend of October 15th and October 16th, 2016. Let's take a look at markets here, and we begin by taking a look at how Asian markets closed on Friday. Pretty much, let's call it an up day for the most part. European markets also closed positive. Let's call it about 1% on average on Friday. And with about 3 hours to go on Friday, we can see that the Brazilian market is up 1%, Canadian market slightly down, S&P 500 slightly up. Let's take a look at those charts. Now, if I could summarize this video, what we're going to see across the globe is, again, for the third consecutive weekend, markets are still stuck in this range. We don't know which way the market is going to resolve, either for a breakout or if the market is going to break down. Now, I'll discuss with you why I still maintain the view for now that most markets are generally pointing down as long as the monthly RSI and the monthly charts are pointing down. In other words, as long as your markets are down for the month, the pressure continues to be to the downside, in my opinion. Let's begin with Australia, and we can see that a little bit of a pullback coming into the end of the week here, and it's consistent with our previous analysis that what the market was doing was coming back to test this break on the RSI, which brought the market off the highs of late August. We came here, we were unable to hold above that line of resistance, and of course the market is now responded by moving lower, so no surprise there. And as we've been maintaining over the last couple of weeks, the Australian market is pretty much one of the world markets that is already showing this resistance on the monthly chart, which net suggests that we are still stuck in a downward spiral for now until we can clear either this line or until we can clear the previous break line. So this break line here brought the market, so the break there brought the market off the highs of 2015. We haven't been back to those levels, so all you have to do is extend that red line and make it relevant in the current market. About 2 months ago we hit that line, and we've been pulling back ever since. So here the market still continues to struggle on the monthly chart. That's why I say day to day the market could bounce, but over time, so far it looks like markets are still pointing down, especially the Australian market. Take a look at the Chinese market. Continues to trade within a wedge, as we've been discussing the last couple of weekends. So we are still stuck in that wedge formation. We don't know which way it's going to resolve, either for a breakout or for a breakdown, so we have to wait for that to play out. And also on the weekly, we know that any true move to the upside would have to move above this recent 2016 weekly closing high. So one can still expect this market to struggle, or at least not be very bullish. It needs to move above 3,108.10. Again, 2016's weekly closing high. Without a breakout here, one can expect this market to be sideways. If not that, then eventually it might have to roll over. If you take a look at the Japanese market, just like we saw with the Chinese market, the daily chart continues to be stuck in a wedge. Take a look at the weekly. You see the same wedge if you take the recent weekly closing highs. So eventually the market is going to have to resolve this wedge formation, either by breaking out or by breaking down. Now keep in mind, if the market is truly to move higher, it needs to clear the recent weekly closing high. That's the first challenge. This week it did try to move above that range. That range is at 16,965.76. So without a breakout above the recent weekly closing high, one can expect this market to eventually roll over. And this is not the only market that has failed to break out recently. Take a look at the Indian market by way of the Nifty. You can see that the breakout attempt above 2015's weekly closing, all-time weekly closing high, failed. So again, we talked about that a couple of weeks ago, that failure to hold above 8937.75 was net a bearish, and we can see that that is true because since then the market has rolled over the last 4 or 5 weeks. Also keep in mind that there was also a failed monthly breakout attempt. As you can see here, this was the level we were watching for a potential all-time high breakout on the Nifty, and the level there that we were watching was 8844.60. So this is the current all-time monthly closing high. We tried to break out here, was rejected. We tried again here, was rejected, and there was a slight attempt even, we can say, early this month. So that's a problem here, that the markets are showing failed breakouts. Generally speaking, failed breakouts are notorious for taking markets lower. Keep in mind there is the obvious ramifications of this failed breakout. Here, this breakout attempt came with the RSI failing to hold above 61.8. That's a big problem. In fact, if you add on to the idea that this is where markets have been struggling as far as the Nifty is concerned, going back to the major bear markets for the last 20 years, we can see that all of these bear markets since 94, and I'm sure if you go backwards also, come with the break below this red line. You can see even off the highs of 2007 for this bear market here, resistance here for this bear market in 2011, and now we are back below this level here. So that's a problem. The monthly chart on a long-term perspective do not look good. If you go back to that weekly chart, you can see that the most pressing need here for bulls is to hold this recent weekly closing low. That level is 8572.55. Anything below that and this market is giving a short-term sell signal. Now what's really confusing here is if you take a look at the Nifty's daily chart, there are signs of hope that the market can stabilize around here, and I'll share with you why. Because if you take a look at this movement in the RSI, so coming off the lows, this RSI movement off the range brought the market off the lows here of late February. Of course, we've been higher since. So all we need to do is draw a line, and every time the market comes to this line and shows uniform action support, we consider that a buy. The market did come close here for this re-entry, and over the last, let's call it 2 weeks or so, the market has held here, and as of Friday's close, doing its best to hold. So if the market can move back above this green line of support, that would be where you can expect the market to start recovering. Now keep in mind, this is also looking like it could end up being positive divergence. Why? Because the market made a slight lower low, but the RSI is trying to show an improvement. So, but the big deal here is if the market can hold this line here, that goes back to this entry off the lows of late February 2016, of course. So again, we hold this line, or if we break through it, then that's indication from a visual perspective that support has failed and the next meaningful direction is going to be lower. So either we get support here immediately, or we break this support for a continued move lower. Again, watch that weekly chart, because the recent weekly closing high here can be used to gauge market strength or market weakness. Again, this recent closing low there, if the market breaches that close, and again that close, the recent weekly closing low is at 8572.55. Anything below that would be bearish. Otherwise, support around this level is what the bulls want to see. Another market that also failed to break out was the South African market. You can see here the breakout attempt failed, and again, failed breakouts are notorious for taking markets lower. Since the failed breakout here, here, and here, of course, we see the market did move lower. The weekly also failed, clearly. And again, just to show what happened here, there was a breakout attempt a couple weeks ago, if not months ago, that failed. And since then, after the failures here, here and here, the market did roll over. But now it looks like there's a little bit of a changing equation, especially if the market can hold around here. And I'll explain why in a second, because the market essentially is coming back to test the perfect entry on the monthly. So this move here sometime in January brought the market off the lows. And so we know that the market, if it can bounce on this line, would be a good buy signal. So we are coming back to test that level. Of course, we don't know that the market is going to hold or not, but this is where you'd expect support to take place. So essentially, we need to watch for support here or for failure now that it's coming back to test this entry off the lows of 2016. Also on the daily, this is where one can expect it to start showing some type of support. And you can see on the daily, it's already responding to this level. Why? Because this is where the RSI moved off the lows in February. And since then, it has been good support. So this green line, every time the market bounces here, again, the key is if the bounce is with uniform RSI action. Here there was uniform RSI action for the re-entry there, uniform RSI action for the support here, and here we've seen multiple support on that line, and each of them has led to a little bit of a move higher. So now the question is whether the market can still hold above and continue bouncing on that green line. So far we are seeing that it's holding, and one can expect this to be the beginning of a recovery. And again, it just depends on whether the weekly chart can also hold this line. If you take a look at European markets, and here I'm using the EuroNext 100, you can still see that they are still stuck in a wedge. This has been the case over the last couple of weeks. In fact, if you go back and just draw a simple line connecting price highs and also price lows, you get a wedge like this, or you can even draw it like that. At any rate, we are still stuck in what looks like a well-formed wedge. The market might have to resolve either for a breakout or for a breakdown above or below this wedge. This wedge formation is also taking place on the weekly RSI, as you can see. So it looks like the market is setting up eventually to break out of this range for the next meaningful swing trade. Take a look at the French market, and you can see here that the French CAC 40 is also in a price wedge. This is similar to the DAX, which is also stuck right now in what looks to be like a well-deformed wedge type formation. If you take a look at the FTSE from a weekly chart, one can see that the weekly breakout as of right now has failed for 2 consecutive weeks. That's not good. Also keep in mind we made an improvement in recent weekly closing highs, but there seems to be some type of negative divergence. So you can see that here with a failed breakout, negative divergence, one can conclude that more than likely the next meaningful swing trade as of right now is for markets to go lower. And if you take a look at the EuroNext 100 monthly chart, you can see the biggest risk here for markets is what we discussed during the last weekend analysis. Is the risk is that this chart moves the RSI to 3-year lows, and that at least one of the MACD is already trading at 3-year lows. So the risk continues to be more to the downside, because a break to 3-year lows and the MACD is continuing to be at 3-year lows suggests that if you slide around here, this is going to lead to a major drop. If you take a look at the Canadian market, since it's down for the month, we continue looking at a bearish looking monthly chart. So irrespective of how the market responds day to day, the fact that we broke off the highs of 14 and 2015, the fact that we've come back to test the break level, and right now for the second month in a row we've been unable to move above this range, that is net bearish long term. In other words, in the coming months, because if you draw a line just like we saw with other markets like the Nifty, this is where the Canadian market has gone into bear market territory. the most recent big breaks, this drop and this drop, all began with the RSI moving below this red line. So the problem here is the monthly chart continues to be bearish. In terms of the weekly chart, what we can do here is just observe how the market responds to either the recent weekly closing low being at 14,450.87, 84, or the high here, this one being at 14,795.70. So clearly we can see that if we break down below the recent weekly closing low, that would be bearish, and at the same time, if we can break out above this range, above the 14,795.70 level, that would be good. So we can watch this range because we are stuck in this range, either for a breakout and a continued move higher, or for a breakdown and the beginning of another move lower. If you take a look at the Brazilian market by way of the EWZ, as of the Friday's action, we are seeing another push to new daily 52-week highs. The problem is that this is coming at the expense of the RSI, which is making a lower low or lower high. So this type of negative divergence eventually sets the stage for a move lower, in my opinion. Keep in mind that if you take a look at the long-term monthly chart, the market is still within testing range of this recent break of the highs here, the highs of 2011. So essentially what we are doing is pretty much coming back to test this level. Now, as you can see, this has been used as failure before for the highs of 2014, and now we are back in this range. It would not surprise me that within a couple of weeks the market is going to confirm resistance on this red line, and that the true direction, or the next meaningful direction for the Brazilian market, in my opinion, continues to be lower. Eric Mwatha with Mwatha.com. As always, good luck, peace and blessings. For those of you looking for US market coverage, be on the lookout for my part 1, which is the US market coverage. Otherwise, enjoy your weekend as always, and see you on the next one. Peace and blessings.